Today, we begin with a major move by the US Federal Reserve. For the third time this year, America's central bank has cut interest rates. But behind the headline lies a story of deep disagreements, rising pressure, and a difficult path ahead for the world's largest economy. Let's break it down. The Federal Reserve lowered its key lending rate by 0.25 percentage points, bringing it to a range of 3.50% to 3.75%, the lowest level in 3 years. This rate influences how expensive or cheap loans become for consumers and businesses, affecting everything from home loans to credit card bills. The goal of lowering rates is simple: make borrowing cheaper, encourage spending, and support jobs. But the decision wasn't smooth. For the first time in months, 3 Fed officials openly disagreed with the rate cut, featuring hawkish and dovish dissents. Now, in Fed parlance, hawks are generally more concerned about inflation and favour higher rates. On the other hand, doves focus on supporting the labour market and want lower rates. Fed Chair Jerome Powell admitted the central bank is in a very challenging situation.
The situation is that our two goals are a bit in tension, right? So, interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately, where do you think the bigger risk is?
And the Fed chair also blamed President Trump's tariffs for high inflation in the country.
If you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path.
Now, the Fed's latest projections suggest only one rate cut next year. And could that even change if new data shows a shift in the economy? The next big decision will come at the Fed's January meeting. But those hoping for aggressive rate cuts, especially President Donald Trump, who has repeatedly pushed for them, may have to wait. After the rate cut was announced, President Trump, who is expected to pick Powell's replacement soon, expressed disappointment.
But we should be able to do a lot better than 3 and 4. We're scheduled to be at 4%, which is pretty amazing because we have a deadhead Fed hair. I mean, this guy, the head of the Federal Reserve, is a stiff, and you fight that. It's amazing. We fight that, and yet interest rates are going down, except with him, not too much. He did a rather, I would say, a rather small number that could have been doubled, at least doubled.
And global markets responded instantly to the decision. In the US, the Dow Jones jumped 500 points before closing. But moving east, the mood in the market shifted. Across Asia, most markets were trading in red. Hong Kong, Seoul, Japan, and Shanghai all traded lower. But Indian benchmark indices Sensex and Nifty opened in the green. Analysts say the drops were led by lower expectations for further rate cuts in 2026 and Oracle's disappointing earnings. They say the rate cut was not needed this time because the job market has not fallen apart completely.
So the job market is not falling apart. The JOLTS numbers, the available jobs actually went up. The employment cost index indicates that people are getting paid, and we've had really robust retail sales. So I can make an argument there wasn't a need for a cut, but many will tell you that they're trying to normalize the yield curve and really help banks, particularly smaller banks and small businesses.
This rate comes at a tricky time. A long US government shutdown earlier this year created a data blackout, leaving officials with less information than usual. It comes as monetary policymakers are trying to support the jobs market, which has been showing signs of weakness for much of the year. Meanwhile, inflation remains above the Fed's 2% target. So, where does this leave the world's most influential central bank? The Fed has delivered 3 cuts this year, but deeper divisions inside the institution are making future moves less predictable. Inflation is cooling, but not enough. Jobs are weakening, but not collapsing. For now, Americans and global markets will have to wait for January to see what happens next.
I was born into revolution. I inherited power like a crown. What I delivered was isolation. I built a personality cult that touched every home. Millions suffered hunger under my rule, but no one dared to speak. I ruled from palaces. My people queued for rice. I called myself the dear leader. History calls me something else, the dictator. Who am I?